Theo, Tim, Vern. Just a quick sound check. Let me know if you can hear me. There's a chat box there, Q&A box, and you can go ahead and place your text there. All right, very good. Thank you, Cheryl. Thank you, Tim. Hey, Sally. Good morning. All right, so today is Tuesday, June 30th. Hey, Rich. Hey, Alan. We're going to take a look at of the orders that's presented here, answer your questions, making sure that anyone who's interested in joining the upcoming class July 7th has an ability to do so. You can visit DayTradeToWin.com and get more information on the mentorship class that's starting, as well as the software and the courses that we offer. All right. Hey, Glenn. Good morning. So this is a live presentation. It's not a pre-recorded session. And so you can go ahead and ask your questions and I'll respond if I can live. Here I have the Trade Scalper. Those of you who have the Trade Scalper should have the same exact signals if you're using a 1-minute chart. It's a little different if you're using a range chart. It provides a different set of entries, similar long and short, but they're a little bit different. There are two entries that the Trade Scalper provides. One is the main signal. The other one is called a double wick signal. It's basically indicating when you see two double wicks based on the rules that there's an opportunity to be a buyer or to be a seller. And so that's why you see here double wick short to go short at 30.3775 and then another short at 30.37. So this is indicating the market is trying to go lower and trying to go lower, indicating the wicks. And this is all taught in the course. It's all included with the training videos. And you also get, I think, Alan, we still have to set you up with a live training for this Thursday for the Trade Scalper, okay? So I do include live training to help answer any of your questions. And the next live training is this Thursday for the Trade Scalper buyers, the Trade Scalper purchasers. So if you're interested in the Trade Scalper, we have a client-only class this Thursday morning at 10 o'clock. All right, Alan? All right, so let me begin first by saying that trading is risky. Please don't trade with funds you can't afford to lose. Talk to your broker and understand the risks involved with trading. As you see the orders that are being generated here, I think it's important to understand the conditions, the volatility. Using a 1-minute chart, the conditions indicate about 3 points. And so typically I like to use that as a basis for the targets. So looking at about 3-point target based on the current conditions. And this could change. The market could get slower, could get faster. But I really like to look at the ATR as the guide to know how much risk is involved as well as the target as well. So when I look at entering long or entering short, I want to make sure that the conditions aren't overly volatile, which means that on the E-mini S&P, it's a little different for other markets, but on the E-mini S&P, it's typically 5 points, which is 20 ticks. And it's the same across other markets, crude oil, NASDAQ, and so on. There's an extreme here. The same thing is if the market's too slow, typically I like to say about a point, 3 ticks to a point on a 1-minute chart. This would be an extreme to the low side. So if the market drops and becomes so slow, there's a lot of whipsaw, a lot of chop. It's typically not a good idea to be trading under those conditions. Alan here, let me just forward that question. Alan has the Trade Scalper, and he has a couple questions here. I have 2 questions. How accurate is it in comparison to using the simulator? If one is doing well in the simulator, might they expect similar results with a live account? I would say if you're doing well practicing in demo on a simulator, Alan, you could expect similar results. There is a difference though. If you're using limit orders put you in a queue, and limit orders say first come, first serve. When you enter into the market, you have to be filled or you don't get filled if your numbers not up, right? So the only real difference, because the data is the same type of data and the same type of entries, except for the limit order fills. Because when you get filled on a limit order live, it's a little different. Actually, sometimes it's better on a live account as opposed to the simulator. So if you're doing well on the simulator using the trade scalper, you can expect similar results, except for when using limit orders, because you have to wait for your turn to get filled. If you're using instead MIT or market if touched orders, I think the MIT orders will be exactly the same. As soon as it touches, you're filled. It's at market. Everybody gets filled, and so there's really no difference between MIT orders in a live account and a simulator account. Utilizing a range of 5 pre-market and 10 market hours. I have found these as good. Okay, so there's a lot of different ways, Alan, that traders are using the Trade Scalper and the Atlas line and all the software. And I encourage you to experiment, because up until recently, the market with a 1 minute chart did very well using the Trade Scalper. And then I got a lot of feedback from traders saying that they use a range of 2. I started testing it, and under normal conditions, the range of 2 works great. If the market's too volatile, it's not going to work with a range of 2, because it's just too fast. You can't do anything with that type of volatility. So let me first start off with what you're asking here. You want to see a range chart of 5. Okay, so this is a range chart of 5, which means that every candle has 5 ticks. That's really what it comes down to. If you're unaware of what a range chart is telling you, it's basically distance. Every time the market moves 5 ticks, regardless of the market, 5 ticks up or down, that's what it's indicating. So every candle is exactly the same. We can't use the ATR because it never changes. It's always going to be roughly 5 ticks. So using a range of 5 is not, in my opinion, doesn't look too bad. It looks okay. What I think the most important thing is when you start looking at different values, range of 5, range of 10, range of 2, I think it has more to do with the volatility, Alan. So if you are looking at a very fast market, increase the number of ticks or the candle size, range of 5, range of 10, I think you'll do much better. If the market is slower, at the same time, you have to use a smaller range of 2 or 3 will work okay. I also have found that a second chart, if you want to test with 30 seconds or 10 seconds, similar results. The entries are based off of price action, as you know, you have the course. So the entries are very similar, except for when you use a range chart, the algorithm calculates it a little bit different and gets you in a little bit faster. So this is a range of 5 here. Let me just go back here in history so everybody can see. Now, there's a lot of signals. I don't expect you to take all of these signals. This is pre-market here. As long as there's enough activity on the ATR, pull up a 1 minute chart on the ATR, and you see the ATR on a 1 minute chart at 1 point, or at least above a point or 3 ticks, you're okay with trading. I think the problem is when it gets too slow, there's not a lot of activity. So this is a range of 5. If you want to look at a range of 10, so I'm going to put here a range of 10. I'm going to expand this out here as well. And the orders are, as you can see, a little bit different. They're not exactly the same as a 1 minute chart, but similarly. The only thing you have to be careful with when using a range chart is that the signal appears and sometimes it runs away from you. So you see here, just as an example, I did a video on this yesterday where the market runs away from you. Try not to chase it, because we don't want to get filled in this area, which is a good 3 points away from where the signal appeared. You want to have as close as possible, within a tick, that this entry, 30, 40, 50, is entered upon. So it could happen immediately. So if this candle gives you the signal and the next candle comes up and fills you, great. In this case, you see how it ran away. Don't chase it. Leave your order, your limit order. Let it come back to fill you within a reasonable amount of time. So in 5 minutes, 10 minutes, you're filled, fine. If you wait too long for the fill to occur after the signal, you have to say that situation, that opportunity is over. So I don't want you to hold on to signals until you get filled and waiting for them. It should be more of an instant situation. It's scalping. You have to get in and you have to get out fairly quickly. And the same thing when it comes to exits. You want to be out of this market once you're subjecting yourself to risk, which is when you're in a trade, you're always subjecting yourself to risk. You want to be out of the market faster, sooner than holding on to it for an hour, as an example. So most of what I teach is based off of price and time, which focuses on you get into the market, get out at a certain amount of time. You get into the market based on breakouts. You get into the market based on pullbacks. You get into the market based on price fluctuations. So you're looking at more price action than you are moving averages, MACDs, momentum. I don't teach any of that. I don't teach candlestick interpretation. I want to instead just follow the price so it leads me where it wants to go, and I'm then going to take a trade based off of that. So as an example, this triggered, you want to get filled here or here, and then you want to get out. All right, so from here to here, how much distance is that? So from here to here, you're looking at a distance of 5 points. Now, I don't know the market's going to move 5 points, and I don't want you to hold on to a trade for 5 points. But if you took 2 points or 3 points or 1.5 points, there's a lot of meat there, a lot. So don't always go for the home run. If you have 3 or 4 trades and you're up for the day, stop. The same thing with this long trade here. You see how this gave you the signal, and maybe you weren't paying attention when it came about or happened too fast, and this occurred. I don't want you to enter here. This is an over. This is not the ideal opportunity because you're entering late to the party, as I like to say. So I prefer to wait for this signal. You can see that it came back within the next 4 minutes, 5 minutes. You're in, and not that I would expect this to occur, but there's nothing wrong with trying for 2 or 3 points and being out of the trade. Alan. Well, when you start talking about parabolic stops and things like that, that's, I think, for another day. That's when you and I get together to do the training. Maybe we can get deeper into looking at different filters and looking at parabolic stops and so on. So let's wait for our training on Thursday. Anyone who has the Trade Scalper or purchases the Trade Scalper will join that class. It's a member-only class on Thursday, Alan. Okay, when you start talking about 6 ticks profit, okay? All right, sounds good. Let's take a look here. Lucas, say one wants to use a Trade Scalper for prop trading. Do you recommend it, or is it just for retail traders? You know, I recommend the Trade Scalper for anyone who wants simplicity to enter and exit, whether you're a retail trader or a new trader, because I don't like to overcomplicate what we're doing here. It's not a complicated method at all, which is a good thing. We're not looking at 5 or 6 different things. And if you're looking at trading, let's say 10 or 20 contracts, you can. You just have to make sure that the market that you're trading, whether it's the E-mini or the oil or something else, that it works and has enough liquidity to get you in and to get you out. So that's really, Theo, that's really the issue. Choose the market that has liquidity. So if you're trading a lot of contracts and you want to be more of a prop trader, you can. There's nothing wrong with that. Most of the traders that I work with are individuals, experienced traders as well as beginner traders, and they love the method because it's a quick in and out. It's simple. There's not a lot that you have to look at to make the decision. And I also think, Theo, you shouldn't trade 24 hours a day. So even being a type of prop trader that you're saying, um, less sometimes is better. Quality is also a better trade, a quality trade, as opposed to taking everything that comes about. All right. You just have to be careful when you start trading above 20 contracts because you get partial fills as well. So that's another thing you have to contend with. Maybe not under this type of volatility and liquidity, but if you're using limit orders and you're trading more than 20 contracts, I've encountered partial fills, and that throws a dent in what we're doing. All right, so if you're trading under 20 contracts, you're okay. If you want to learn more about trading, visit DayTradeToWin.com. Subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software.